Imagine sealing like $1 million in cash inside this highly secure, climate-controlled bank vault.
Okay, yeah, like a total time capsule.
Exactly. And you leave it perfectly untouched for 10 years. I mean, you haven't spent a single dime of it.
Right.
But when you finally spin that dial, and swing the heavy steel door open, you realize half of its value has been completely vaporized.
Which is a terrifying thought for anyone holding cash.
It really is. And today, we are opening up the official National Institute of Securities Markets, or NISM workbook, for portfolio management services distributors.
Yeah, the PMS distributors.
Right. And we're going to explore why your quote-unquote safe cash is actually the single riskiest asset you own.
It really challenges everything we are taught about safety.
Totally. So whether you are managing your own portfolio or you are just insanely curious about the actual underlying mechanics of how the financial world ticks, this deep dive is for you.
Absolutely.
We have a very laser-focused mission today. We are completely unpacking Chapter 1, which is just titled Investments.
I mean, it sounds like such an unassuming title, right? Just investments.
Yeah, very textbook.
But the premise of this chapter challenges a lot of the conventional wisdom we hold about money. Like, we tend to view cash as this static store of value.
Which makes sense intuitively. A dollar is a dollar.
Right. But in reality, the global economy is explicitly designed to penalize static capital.
Okay, let's unpack this. We are going to demystify the foundational concepts of investing today, completely bypassing the abstract textbook definitions, right?
Yeah, we want to look at the mechanics.
Exactly, the mechanical vehicles and channels that actual professionals use to build wealth. We're talking about the exact same frameworks that high net worth portfolio managers use to evaluate capital.
The real deal.
But before we get into the architecture of those financial vehicles, we kind of have to look at the fundamental human condition that necessitates investing in the first place.
Which is fascinating that a finance workbook starts with biology, essentially.
Right. The source material anchors everything in what it calls the life cycle pattern of savings.
Yeah, and that life cycle pattern is literally the bedrock of all financial markets.
How so?
Well, financially speaking, humans pass through these distinct economic phases, and our ability to produce capital rarely aligns with our need to consume it.
That timing mismatch.
Exactly. Think about the early phase of adulthood, right? You are acquiring education, maybe housing, a car.
Right. All the expensive stuff.
Yeah, and your consumption requirements vastly exceed your productive output at that age. I mean, you are operating in a structural deficit.
So you have to borrow. You are essentially pulling forward future capital just to consume today.
Which leads right into the middle phase.
The peak earning years.
Exactly. Your career matures, your productive output peaks, and you finally enter a period of surplus.
You're finally making more than you spend.
Right. You are generating more capital than you require for daily consumption. But, and this is the kicker, that surplus is temporary.
Because we all get old.
Yeah. Eventually, everyone reaches the drawdown phase, which is retirement. Your productive output drops to near zero.
But you still have to eat. You still have to pay for healthcare and housing.
Exactly. Your consumption requirements continue until the end of your life.
So we have this massive chronological mismatch. We need capital when we aren't producing it, and we produce excess capital when we don't immediately need it.
That's the human condition.
I guess that creates the central engine of the financial markets, right? Moving capital across time.
That is exactly what the market does.
So those with a surplus in their middle years transfer their funds to those operating in a deficit, whether that's like a young person buying a house or a corporation building a new factory. Yeah.
But you have to remember that transfer isn't an act of charity.
No, nobody is just giving away their surplus.
Right. The fundamental trade-off of investing is postponing your current consumption. You are delaying gratification today in exchange for an expected higher amount of consumption in the future.
Which brings up a really critical distinction in the NISM text, the difference between saving and investing.
Oh, this is huge. People use those interchangeably all the time.
All the time, in casual conversation. But mechanically, they are entirely different operations, aren't they?
Completely different.
So saving is just the residual math. It's the raw difference between what you earned and what you consumed.
Yeah, income minus expenses equals savings.
And it's generally short-term, and it demands high liquidity. Like, you are holding capital in reserve to deploy it imminently.
Right, for a medical emergency or a down payment you need next month.
But investing, however, is taking that saved capital and deliberately logging it into a mechanism for a specific time period to capture a return.
That liquidity trade-off is the defining variable here.
You give up access to get growth.
Exactly. Saving prioritizes immediate access over growth. Investing prioritizes growth over immediate access.
Let me see if I can put a visual to this for you. So saving is essentially like putting your money in a waiting room.
I like that.
You are keeping your capital in this defensive perimeter, just making sure it doesn't get lost so you can grab it at a moment's notice.
Right. The money isn't doing anything. It's just sitting there safely.
But investing is putting your money to work in a factory. You are taking that capital, walking it outside the perimeter, and deploying it into the supply chain of the economy.
You are forcing it to participate in the generation of new economic value.
Yeah, exactly.
And if we connect this to the bigger picture, the aggregate of all those individual decisions, whether to hold capital in the waiting room or deploy it into the factory, literally dictates the macroeconomic reality of the world.
Wait, really? Just a collective decision of everyone saving versus investing?
Yeah, the collective time preference of a society determines the real risk-free rate of interest.
Okay, break that down for me.
So if an entire population decides they want to consume everything today, capital becomes incredibly scarce, right?
Because nobody is putting money into the factory.
Exactly. So borrowers have to offer massive interest rates to entice anyone to postpone their consumption.
Nah, I see.
Conversely, if a society saves aggressively, capital becomes abundant. The cost of borrowing drops, which fuels corporate expansion and innovation.
That is fascinating. It's a massive macroeconomic balancing act. And when we do decide to deploy that capital, the workbook separates the targets into financial assets and real assets.
Yes, the two main buckets.
So financial assets being your paper claims, like shares, bonds, bank deposits.
Right, contracts, basically.
And real assets being tangible, physical properties like gold or real estate.
Stuff you can touch.
Yeah. But this brings up a huge point of friction. Because if investing is deploying your capital into the economy to generate value, how do we distinguish between a disciplined allocator of capital and someone who is just rolling the dice at a casino?
That is the million-dollar question.
Because the line between investment and speculation seems incredibly blurry to a lot of people.
It is arguably the most debated line in finance.
I bet.
The NISM workbook points out that financial transactions exist on this infinite continuum of time, right?
Okay.
You have high-frequency trading algorithms executing in microseconds, and then you have massive university endowments holding assets for literally a century.
And the common wisdom is always duration-based. Like, the assumption is always that if you are trading in and out of a position in 3 days, you must be speculating.
Right.
But if you buy and hold for 10 years, you are investing.
Yeah, and the workbook explicitly rejects that.
Really. So the clock doesn't matter.
Defining speculation merely by a short-term horizon is a historically common fallacy. Duration does not dictate the nature of the act.
So what is the mechanical difference then? If it's not time, what separates them?
Well, the text looks at the foundational dictionary definition of speculation, which is forming a theory or conjecture without firm evidence.
Without firm evidence, huh?
Yeah. True investing requires a rigorous evidence-based process to determine the intrinsic value of an asset.
Meaning what exactly?
Meaning you are evaluating actual cash flows, balance sheets, market share, macroeconomic tailwinds. An investor only deploys capital when their calculated intrinsic value is higher than the current market price.
They did the math, basically.
Exactly. Speculation, by contrast, ignores intrinsic value entirely.
So what are they looking at?
The speculator is entirely focused on price momentum and market psychology. They are just attempting to profit from the actions of other buyers, regardless of what the underlying asset is actually worth.
But wait, I have to stop you there and push back a little.
Sure.
Because intrinsic value is a great textbook concept, but in the real world, it's highly subjective.
It definitely involves assumptions.
Right. I mean, look at the tech sector over the last decade. You had these massive publicly traded software and AI companies operating at multi-billion-dollar losses year after year.
Oh, absolutely.
There were zero positive cash flows to discount. So their intrinsic value on paper was zero, or even negative. Yet people who bought them made absolute fortunes.
Right.
Are you saying anyone who bought into early-stage, unprofitable tech was just speculating?
That is a phenomenal challenge, and it really gets to the very core of advanced valuation.
Because I know people who spent months analyzing those companies.
And that's the key. Intrinsic value is not just a snapshot of current profitability, it is the present value of all expected future cash flows.
Ah, future cash flows.
Yeah. When an analyst builds a model for an unprofitable AI company, they are using probabilistic scenarios. They are estimating the total addressable market, user acquisition costs, and the eventual margin profile once the company finally achieves scale.
So it's still grounded in numbers, even if those numbers are in the future.
Exactly. It is a highly uncertain mathematical model, sure, but it is still a model based on fundamental business metrics. The investor buying that stock has a specific, quantifiable thesis about future cash generation.
I see. So the speculator buys the unprofitable AI company simply because the chart is trending up and they think a bigger fool will buy it from them tomorrow at a higher price.
Bingo! The greater fool theory.
But the investor buys it because they have mathematically modeled the scenario where the company captures, say, 40% of the enterprise software market in 5 years, which generates free cash flow that justifies a valuation higher than today's price.
Exactly the distinction. It is the presence of an analytical framework versus the reliance on blind momentum.
That makes a lot of sense.
And this answers the duration question as well.
Oh, right. Back to the time continuum.
Yeah. If a quantitative hedge fund uses a complex statistical arbitrage model to identify a pricing inefficiency between two correlated bonds, and they execute a trade that lasts for 3 seconds, that is investing.
Wait, a 3-second trade is investing?
Yes, because they identified an intrinsic value dislocation based on firm evidence.
Wow. Okay, that flips the whole script.
Conversely, if an individual buys a meme stock with zero fundamental analysis just because it was trending on social media,
Which happens a lot.
and they happen to get tracked holding it for a decade because the price collapsed, they didn't magically become an investor just because they held it for 10 years.
They just executed a very long, very poor speculation.
Exactly.
So what does this all mean for you listening?
Yeah.
It means your identity as an investor is defined by your process, not your holding period.
That is the core takeaway.
Okay, so once you commit to the rigorous process of being an investor, you have to define what you actually want that process to achieve. You have to map the destination.
You definitely do, which leads directly into the workbook section on investment objectives.
Because you can't just say, make me money.
No, you cannot simply approach the market with the goal of making money. The source material insists that every financial objective must be expressed as a duality.
Duality of what?
Return and risk.
Because targeting return in a vacuum is a recipe for total catastrophic loss.
Right? It absolutely is.
If someone sits down with a portfolio manager and says, hey, my objective is to double my wealth in 12 months, they're only speaking half the language.
They are entirely ignoring the standard deviation, the volatility required to achieve that outcome.
So what does the professional do in that scenario?
The professional's role is to immediately translate that return expectation into its corresponding risk profile.
Which probably shocks the client.
Often, yes. To achieve a 100% return in a year, you must engage in strategies like heavy leverage or concentrated derivative exposure, where the probability of losing 100% of your capital is equally high, if not higher.
Risk leads return, not the other way around.
Exactly.
So to keep people grounded, the workbook outlines 4 practical, balanced objectives.
Yes. 4 main destinations.
The first is capital preservation.
Right. This is the absolute minimization of risk.
So you are prioritizing the survival of the principal over any potential growth.
Exactly. This is the objective for capital you need to deploy very soon, maybe in the next 6 months.
Like you don't put the down payment for your new house into a volatile tech stock.
Never. You keep it in highly liquid, low-risk instruments.
The second objective is capital appreciation.
Now, this is the pursuit of growing the underlying value of the portfolio over a long time horizon.
So this is where you take some chances.
You are intentionally taking on market volatility because your time horizon is long enough to absorb the down cycles.
Because you don't need the money tomorrow.
Right. And that allows the compounding effect of corporate growth to increase your wealth over decades.
Okay, the third objective is current income.
This objective shifts the focus from growing the absolute size of the portfolio to utilizing the portfolio as an engine for cash generation.
So instead of the factory growing bigger, you want the factory to pay you a dividend.
Exactly. You construct a holding of dividend-paying equities, interest-bearing bonds, maybe some real estate investment trusts, all to create a synthetic paycheck.
A synthetic paycheck. I love that phrasing. That's the primary objective for the retirement phase of the life cycle we discussed earlier.
Absolutely. When your labor income stops, your portfolio income has to take over.
And the fourth objective is tax saving.
Yes, which involves structuring the portfolio using specific government-sanctioned instruments to minimize your tax liability.
Which effectively increases your net retained return because you aren't paying as much to the government.
Every dollar saved in taxes is a dollar earned in returns.
Okay, so we have our objective. We know whether we want preservation, appreciation, or income. Now we have to figure out the actual mathematical toll for putting our money into the market.
The hurdle rate.
Right. How do we calculate the absolute minimum return we require to justify postponing our consumption? Because if it's not high enough, we might as well just spend the money today.
Exactly. And the workbook breaks down this required rate of return into 3 distinct mathematical components.
And just to clarify, this isn't a projection of what the market will yield, right?
No, not at all. It is your personal hurdle rate. If an asset cannot clear this specific hurdle, you withhold your capital.
Okay, let's unpack these 3 components. The first is the pure time value of money.
Right. Even in a hypothetical world with absolutely zero inflation and zero risk of default, capital still has a time value.
Because of human impatience.
Partly, but mostly because of opportunity cost. A dollar in your hand today is fundamentally more valuable than a dollar promised to you in 1 year because you could deploy that dollar today to generate utility or further capital.
So you demand a baseline rent just for parting with your liquidity.
Exactly.
The text uses a really clean example here. If I give you 100 rupees today and the baseline risk-free rate is 5%, you owe me 105 rupees next year.
Yes.
The 100 is the present value, the 105 is the future value, but that 5% is just the nominal risk-free rate.
And nominal rates are incredibly deceptive.
Because they ignore the silent destruction of purchasing power.
Exactly.
Which brings us to the second component, compensation for expected inflation.
Ah.
Because the nominal rate only measures the sheer quantity of currency you receive back.
Right. But we don't consume currency. We consume goods and services.
Let me try to visualize this.
Okay.
A lot of people compare inflation to a treadmill, right? Where you have to walk just to stay in place.
It's a common analogy.
But I think a better mechanical analogy is a shrinking yardstick.
Oh, how so?
Well, if your nominal return gave you 5% more yardsticks at the end of the year, you feel richer, right? You have more sticks. But if the central bank expanded the money supply and effectively shrank the actual physical length of every single yardstick by 3%, your ability to actually measure and acquire real goods hasn't grown by 5%.
That is a much more accurate representation of what's happening.
So you have more money, but the money buys less.
Yes. And to find your real risk-free rate, which is the actual increase in your ability to consume, you have to strip out that inflation component.
So if your nominal rate is 5% and expected inflation is 3%,
then your real risk-free rate is roughly 2%. Your actual purchasing power is only growing by that tiny 2% margin.
wow. So time value plus expected inflation gives us the nominal risk-free rate.
Correct.
And this is what you demand to hold a perfectly safe asset, like a short-term government treasury bill.
Because there's basically no default risk there.
Right. But we don't just invest in treasuries. We invest in corporations and volatile startups and leverage real estate projects. These are not perfectly safe.
Far from it. And that introduces the third and final component, the risk premium.
The compensation for fear.
Basically, yes. Every ounce of uncertainty regarding the timing or the magnitude of future cash flows requires mathematical compensation.
So if I'm looking at a corporate bond,
And you perceive, say, a 2% chance that the company might default on that bond, you cannot accept the risk-free rate.
because I might lose everything.
Exactly. You must add a risk premium to your hurdle rate to compensate for that statistical probability of loss.
So the formula is essentially a stack.
A stack, yes.
Pure time value plus expected inflation plus the risk premium equals your required rate of return.
That is your absolute minimum hurdle.
So if a real estate project is projecting an 8% return, but your required stack adds up to 10% based on the risks,
You pass. It is financially illogical to deploy the capital in that scenario.
this framework is great because it forces you to quantify exactly what you were afraid of.
It makes fear mathematical.
And the workbook spent a lot of time deconstructing the specific types of risks that comprise that premium, right? Let's dive into Section 5, the spectrum of uncertainty.
It's quite a spectrum.
Before listing the specific threats, the text defines risk mathematically. Because like you said, it isn't just a psychological feeling of anxiety. Risk is defined as the statistical dispersion around an expected average return.
Yes, and we measure this through standard deviation.
How did that work in practice?
Well, if an asset has an expected average return of 8%, But historical data shows it routinely springs up to 25% and then crashes down to negative 15%. It has a massive standard deviation.
So the average is 8, but the ride is terrifying.
Precisely. The average might look appealing on a chart, but the reality of holding the asset is violently volatile.
So the wider the potential dispersion of outcomes, the higher the mathematical risk.
Yes.
Okay, so what actual forces cause those violent swings? The text categorizes them meticulously. Let's go through them. First is business risk,
Right. This one is internal to the specific enterprise.
like bad management.
Yeah, it's the risk that the company's management team fails to execute, or their product becomes completely obsolete, or they just lose their competitive advantage.
The classic example is a legacy retail chain failing to build an e-commerce infrastructure, right? Like Blockbuster ignoring streaming.
Perfect example. Their revenues collapse not because the broader economy is failing, but because their specific business model was rendered irrelevant.
Okay, so business risk is about the operations. Next is financial risk, which seems to be more about the balance sheet.
Correct. Financial risk is directly tied to how a company chooses to fund its operations,
Mainly debt, right?
specifically its use of debt. Leverage acts as an amplifier.
How so?
If a company borrows heavily to expand and their business slows down even slightly, the fixed interest payments on that debt can rapidly consume all their operating profit.
Which pushes them into insolvency.
Very quick.
Got it. Then we have liquidity risk. We touched on this earlier with the idea of the defensive perimeter versus the supply chain.
Right. Liquidity risk is the danger that when you attempt to exit an investment, the bid-ask spread widens dramatically.
The bid-ask spread being the difference between what buyers are willing to pay and sellers are willing to accept.
Exactly. If you hold heavily traded sovereign bonds, you can liquidate $1 billion in seconds without moving the market price at all.
Because there's always a buyer.
Yes. But if you hold a massive position in a tiny microcap stock and you need to sell quickly to raise cash, there simply aren't enough buyers.
So what happens?
You are forced to continuously lower your asking price just to entice liquidity out of the market. You suffer a massive haircut purely because of the frictional mechanics of the trade.
That sounds brutal. Next on the list is exchange rate risk. And for anyone investing outside their home country, this is a massive variable.
It can wipe out your entire gain.
You could make a brilliant investment, the business could execute perfectly, the stock could soar, and you could still lose purchasing power.
Let's walk through the mechanics of that because it trips people up.
Okay, lay it out for me.
Imagine an investor based in India deploying capital into a U.S. technology stock.
Okay.
The U.S. stock appreciates by 15%, a fantastic fundamental outcome for the business.
Great job, you picked a winner.
However, during that exact holding period, the macroeconomic dynamics shift, and the Indian rupee strengthens against the U.S. dollar by 20%.
Oh, wow.
So when the Indian investor sells the U.S. stock and repatriates the capital, converting those dollars back into rupees, the exchange rate completely obliterates the 15% equity gain.
Because the dollars they got back are worth less in their home currency.
Exactly. They actually suffer a net negative return in their domestic currency despite picking a winning stock.
It's a dual variable equation. You are simultaneously taking a position on the asset and taking a position on the relative strength of the two sovereign currencies.
Which is why institutional managers spend millions on complex currency hedging strategies. They want to isolate the asset performance from the currency fluctuation.
Because they only want to bet on the company, not the global FX market.
Right.
And the final cluster of risks involves macro-level disruptions, political, geopolitical, and regulatory risk.
The big macro forces.
Right. And as a quick reminder to you listening, we are strictly analyzing the mechanical market impact of these events here, completely independent of any political stance or ideology. We're just looking at how the dominoes fall.
Just mechanics.
So geopolitical risk involves the friction between sovereign states, like tariffs, trade embargoes, or military conflicts.
And regulatory risk is usually domestic, like a sudden shift in taxation policy, antitrust enforcement, or new environmental mandates.
But here's where it gets really interesting. The workbook illustrates that none of these risks operate in a vacuum.
No, they are deeply, deeply interconnected.
They are an interconnected web. Let's trace a hypothetical chain reaction to show how this works. Suppose a geopolitical conflict erupts in a region that produces a massive percentage of the world's semiconductor components.
Okay. The immediate impact is a supply shock. So geopolitical risk immediately manifests as a physical bottleneck.
Right. And because those components are now incredibly scarce, their price skyrockets.
Yes.
This immediately triggers business risk for, say, an automobile manufacturer on the other side of the planet. Their input costs have just doubled, destroying their profit margins,
And if that automobile manufacturer is heavily leveraged,
which they usually are.
the collapse in profit margins triggers financial risk. They struggle to service their massive debt, leading credit agencies to downgrade their bonds.
And then if a major global macro fund holds those downgraded bonds and they suddenly need to raise cash to cover their losses,
They might try to sell off exotic, illiquid assets in their portfolio, triggering massive liquidity risk.
so one geopolitical spark cascades through the entire financial ecosystem. It mutates into business, financial, and liquidity crises across completely unrelated sectors.
It's a chain reaction. And this raised an incredibly important question for modern portfolio theory.
Which is,
If you cannot predict the initial spark and you cannot map the infinite complexity of all those cascading dominoes, how do you defend the capital?
you can't just hide it in a vault. We established that.
No. The mathematical answer is diversification.
Diversification.
You assemble a portfolio of assets whose underlying drivers are fundamentally uncorrelated.
So they don't all fall down at the same time.
Exactly. You mix equities that thrive in economic expansion with sovereign bonds that usually rally during panic and commodities that act as inflation hedges. You ensure that no single macro variable can simultaneously destroy every asset in your vault.
Which perfectly transitions us to Section 6, the playground.
The fun part.
We know the destination, we've mapped the risks, and we understand our required rate of return. What are the actual mechanical vehicles we can use to construct this diversified portfolio?
Well, the source material starts with the most ubiquitous asset class of all, equity.
Stocks.
Yes. But when you purchase equity, you have to remember you are not simply buying a ticker symbol blinking on a screen.
It's easy to forget that on Robinhood.
It really is. But legally, you are acquiring a fractional ownership stake in a going concern, a real business. And the defining characteristic of equity is that it represents a residual claim.
Okay, let's break down the mechanics of a residual claim because I think it perfectly illustrates why equity carries both the highest risk and the highest potential return.
It's the core concept of stock ownership.
So imagine a corporation goes completely bankrupt and is forced into a total liquidation waterfall.
The liquidation waterfall is the rigid legal hierarchy of who gets paid from the sale of the company's remaining assets.
So they sell off the desks, the patents, the buildings.
Everything. And at the very top of that waterfall are the secured creditors, usually the banks, and the government claiming unpaid taxes.
The tax man is always at the top.
Always. Below them are the unsecured bondholders, the suppliers, and the employees owed wages. As the cash flows down this waterfall, it is systematically drained by these claims.
And the equity holders, the stockholders, are standing at the absolute bottom of the waterfall.
Precisely. If the cash runs out before it reaches the bottom, which it usually does in a bankruptcy, the equity holders are wiped out entirely.
They get zero.
Zero. Their claim is purely residual. They only get whatever is left over after everyone else has been made whole.
So why on earth would anyone choose to stand at the bottom of the waterfall? It seems like a terrible position.
Because while the downside is a 100% loss, the upside is structurally infinite.
How so?
Think about the bondholders at the top of the waterfall. Their return is legally capped. If a company issues a 5% bond and then suddenly invents a revolutionary technology that increases its value by 10,000%.
The bondholders still only get their 5%.
Exactly. They only receive their 5% interest and their original principal. But the equity holders, because they own the residue of the enterprise, capture absolutely 100% of that explosive growth.
So equity is the mechanism for capturing infinite upside in exchange for absorbing the maximum downside.
That is the trade-off of ownership.
Okay, so moving up the capital structure, we have fixed income, the debt vehicles.
With fixed income, you transition from an owner to a lender.
Your mindset shifts entirely.
It does. Your primary objective shifts from capital appreciation to capital preservation and current income.
You just want your steady paycheck.
You are exchanging the infinite upside of equity for a legally binding contract that mandates specific interest payments and the safe return of your principal.
But the workbook is very, very careful to distinguish between the entities you are actually lending to. A sovereign government bond and a corporate bond operate in completely different risk universes.
Oh, completely different.
Let's talk about sovereign debt first.
So, sovereign debt issued by a stable government in its own fiat currency, represents the closest thing we have to a risk-free asset.
Why?
Because the government has the ultimate monopoly on taxation and the legal authority to literally print the currency required to service the debt.
So they can't technically run out of money to pay you.
Right. Therefore, the credit risk, the risk of outright default, is theoretically negligible.
But a corporation is different.
Very different.
I s-
Corporate debt carries immense credit risk because a corporation cannot print money or tax citizens to escape insolvency.
If they run out of cash, they're done.
Exactly. Consequently, corporate bonds must offer a significantly higher yield, a credit spread, to compensate the investor for that statistical probability of default.
But the text highlights a massive, often misunderstood trap in the fixed income market.
Yes, interest rate risk.
Because people assume that because a bond is mathematically fixed, its value doesn't fluctuate.
It's a huge misconception.
But the market value of a bond is actually highly volatile, and it moves inversely to the broader interest rate environment.
This is a really crucial mechanical concept. Let's look at the arbitrage mechanism that drives this.
Walk me through it slowly.
Okay. Let's say you purchase a newly issued 10-year corporate bond. It has a face value of $1,000, and it pays a fixed 5% interest rate.
So I am receiving $50 a year in interest.
Correct. But a year later, the central bank aggressively raises interest rates to combat inflation.
Like we saw recently.
Exactly. Now, newly issued corporate bonds of the exact same risk profile are yielding 7%.
So new bonds are paying $70 a year.
Right. So if you hold that original 5% bond and you suddenly need to sell it on the open market to raise cash, you have a major problem.
Because why would anyone buy my bond? No rational investor is going to pay me $1,000 for my bond that only generates $50 a year.
When they can take their $1,000 to the exact same open market and buy a brand new bond that generates $70 a year.
So how do I sell it?
To convince a buyer to take your inferior 5% bond off your hands, you must discount the price.
I have to take a loss.
You have to lower the asking price of the bond from $1,000 down to, say, $850.
Oh, wow.
By reducing the upfront cost, the buyer's effective yield to maturity on your bond mathematically aligns with the new 7% market reality.
That is the arbitrage. The price of the bond must fall so that its effective yield matches the new environment.
It's mathematical gravity.
So even if the corporation never defaults and the bond is perfectly healthy and paying its interest, a rising interest rate environment inflicts severe capital losses on anyone forced to sell before maturity.
Which is why duration matching is so critical.
Duration matching.
Ensuring the maturity date of your bonds perfectly aligns with when you actually need the capital back. If you hold to maturity, the price fluctuations don't matter. The risk only materializes if you have to sell early.
That makes perfect sense. Okay, moving beyond paper contracts, the playground includes commodities. The text divides these into soft and hard commodities.
Yes, soft commodities are agricultural and biological. Wheat, coffee, soybeans, corn.
Stuff we grow.
Right. They are highly perishable, and their pricing is governed by hyper-localized factors like weather patterns, crop diseases, and seasonal supply cycles.
And hard commodities.
Hard commodities are extracted from the earth. Crude oil, industrial metals like copper, and precious metals like gold and silver.
Gold occupies such a unique space in the financial psyche.
It really does.
The workbook highlights its historical role as a safe haven and an inflation hedge. But there's a massive structural difference between holding equity and holding a block of gold, right?
Oh, absolutely. The critical distinction is that commodities produce zero fundamental yield.
Zero yield,
Yeah,
meaning they don't produce cash.
exactly. When you buy agricultural land, the land produces crops you can sell. When you buy a business, it generates cash flow.
But when you buy a brick of gold,
It does absolutely nothing. It just sits in a vault. It doesn't pay a dividend. It doesn't pay interest.
it's completely inert
In fact, holding physical commodities usually has a negative yield.
because you have to pay to store it.
Right. You pay for storage, you pay for insurance, you pay for arms security.
So the only mathematical way you generate a return is if the broader fiat currency devalues, or if panic drives another investor to pay a higher premium for that inert block of metal in the future.
It's purely price speculation in that sense. But what's fascinating here is why sophisticated institutions still allocate billions of dollars to these zero-yield assets.
Why do they, if it costs money to hold?
It isn't because they anticipate massive compounding growth. It is purely for portfolio construction.
Back to diversification.
Yes. Commodities frequently exhibit zero or even negative correlation to traditional equities and bonds.
So they zag when the stock market zigs.
Precisely. During a severe inflationary shock where both stocks and bonds are plummeting simultaneously, hard commodities often aggressively spike in value. They act as a massive counterbalance that stabilizes the total portfolio.
Okay, next we have real estate, the ultimate tangible asset. Everyone's favorite.
Real estate is incredibly popular because it offers a unique dual-engine return profile.
Dual engine. You get appreciation and income.
Right. You can capture current income through monthly rental yields, and you get long-term capital appreciation as the underlying land value increases over decades.
It's the best of both worlds.
Furthermore, commercial leases often have inflation escalation clauses built directly into the contracts.
Oh, so if inflation goes up, the rent automatically goes up.
Exactly, making real estate a highly effective structural hedge against inflation.
But the friction is immense.
It's probably the highest friction asset class.
Because real estate requires massive capital concentration. You can't just buy $50 worth of a house.
No.
And it usually involves taking on heavy mortgage debt, which, as we learned, amplifies your financial risk.
Right, leverage is a double-edged sword.
And it suffers from profound liquidity risk. You can't liquidate an office park with a mouse click.
Not at all.
Yeah.
It takes months of due diligence, legal friction, appraisals, and massive transaction costs like broker fees just to convert the asset back into cash.
So it's a huge commitment. And that leads us to the final two, highly complex corners of the playground: structured products and non-traditional investments.
This is where things get really exotic.
Let's decode structured products first. From reading the text, it honestly sounds like financial alchemy.
It essentially is alchemy.
How are they built?
Investment banks design structured products by mathematically blending traditional assets like bonds with complex derivative contracts
To achieve what?
to create hyper-customized payoff profiles. For example, an institution might engineer a note that guarantees the absolute preservation of your principal over 5 years.
So you can't lose money.
Right, while simultaneously offering you 50% of the upside of the S&P 500 index.
Okay, wait. That sounds like a magic bullet. All the upside, none of the downside.
Sure.
What is the hidden mechanical cost there?
There's no free lunch in finance. The hidden costs are opacity and counterparty risk.
Explain counterparty risk.
Well, these products are synthetically created using complex options pricing models that the average retail investor cannot possibly verify. The bank embeds massive profit margins into the pricing.
So you're overpaying to the structure.
Usually, yes. But more importantly, you are not actually buying the S&P 500.
Well, my buy.
You are buying an unsecured promissory note from the investment bank that created it.
Oh,
If that specific bank faces a liquidity crisis and goes bankrupt,
like 2008.
exactly, your customized downside-protected derivative contract immediately becomes worthless.
Yeah.
Your brilliant market strategy is completely annihilated by the credit failure of the issuer.
Wow, so you're taking on massive credit risk of the bank itself.
You are betting on the bank's survival just as much as the stock market.
Okay, and finally, the non-traditional bucket. The workbook literally lists art, distressed debt, and racehorses.
Yes, horses.
I found this fascinating. You can actually allocate capital to a biological asset like a horse.
It represents the extreme end of the alternative investment spectrum.
I mean, I imagine the maintenance costs on a horse are a bit higher than the expense ratio on a mutual fund.
Just a bit. With fine art, rare collectibles, or thoroughbred syndicates, you are entirely detached from traditional cash flow discounting.
You can't build a DCF model for a painting.
Right. The valuation is driven entirely by scarcity, cultural cachet, and hyper-niche market dynamics.
But the illiquidity premium must be staggering.
It is absolute. Finding a buyer for a multi-million-dollar Picasso during a global credit crunch is nearly impossible.
Yeah, nobody's buying art when the banks are failing.
And valuing distressed debt like buying the bonds of a company that is currently in bankruptcy court requires teams of specialized bankruptcy lawyers to navigate the litigation.
It's not for the faint of heart.
No. These assets require profound specialized expertise, and the transaction costs are astronomical.
So why do it?
Because, again, a collapse in semiconductor manufacturing doesn't alter the aesthetic value of a Renaissance painting.
Ah, true non-correlation.
They are the ultimate uncorrelated diversifiers for ultra-high net worth portfolios.
Okay, so we've surveyed this entire landscape of vehicles. But An investor cannot simply walk onto the floor of an exchange with a briefcase full of cash and demand to buy a corporate bond or a fraction of a mutual fund.
Security guards would escort you out very quickly.
Right. You have to route your capital through a specific infrastructure.
Hmm.
And that brings us to Section 7, the gatekeepers.
The channels?
Yes, the NISM workbook provides a very rigorous taxonomy of these channels, separating them into direct and indirect or managed avenues.
Let's start with the direct channels.
Yep.
This is where you, the investor, are retaining the ultimate decision-making authority over the portfolio.
You are picking the investments.
Yes, and you will interact with one of three primary entities. The first is a distributor.
Like a mutual fund distributor.
Correct. A distributor acts as a sales intermediary between the asset management company that created the financial product and the retail investor.
Okay. What's the mechanical detail we need to know here?
The critical detail is the compensation structure. Distributors are typically compensated via commissions paid directly by the asset management company.
Which introduces a glaring structural conflict of interest.
Absolutely glaring.
Because they want to sell whatever pays the highest commission.
If a distributor analyzes two different mutual funds, and Fund A is mathematically superior for your specific tax situation, but Fund B pays the distributor a significantly higher upfront commission.
The incentive structure is profoundly warped.
Yes. The regulatory framework requires them to act fairly, of course, but the economic reality of commission-based sales is a massive headwind to objective advice.
Okay, the second direct entity is the broker.
Brokers are the execution infrastructure. They operate the toll booths to the actual exchanges.
So you have to go through them to buy the stock.
Right. And they range from highly streamlined, low-cost digital discount brokers where you execute your own trades via an app for fractions of a penny.
The Robinhoods and Zerodahs of the world.
Exactly. To full-service institutional brokerages that provide proprietary macroeconomic research, deal flow access, and trade execution for a significantly higher fee.
And the third direct channel is the Registered Investment Advisor, or RIA. This seems to be the regulatory answer to the conflict of interest problem we saw with the distributors.
It absolutely is. Under the Securities and Exchange Board of India, or SEBI regulations, an RIA is bound by a fiduciary duty.
And that's a legal term.
It is a massive legal distinction. A fiduciary is legally mandated to place the client's financial interests above their own.
How do they enforce that mechanically?
To enforce this, the compensation mechanics are completely severed from the product manufacturers. An RIA is compensated directly by the investor, usually as a flat fee or percentage of assets under management.
So they don't get a cut from the mutual fund company.
Crucially, they are legally prohibited from accepting any commissions or kickbacks from the mutual funds or structured products they recommend.
That completely aligns the incentives. They only make more money if your portfolio grows. And they have no incentive to steer you toward high commission garbage.
Exactly.
Okay, so those are the direct channels. But what if the investor has zero desire to navigate the macroeconomic dominoes or calculate intrinsic value?
Many people don't.
They just want to hand the capital over to a professional architecture. That leads us to the indirect or managed channels.
Yes, and the managed channels represent a clear hierarchy of complexity, customization, and regulatory access.
Let's start at the foundation.
At the foundation, designed for the mass retail market, we have mutual funds.
The ultimate engine of financial democratization.
Mechanically, a mutual fund pools the capital of millions of individual investors into a single massive trust.
And who drives the trust?
This pool is managed by a professional portfolio manager who deploys the capital across hundreds of different securities.
What's the main advantage for the little guy here?
The primary mechanical advantage is economies of scale. An individual with $100 cannot possibly buy a properly diversified portfolio of 500 stocks. The transaction fees alone would eat the $100.
Right.
But by buying a single unit of a mutual fund, they instantly acquire microscopic fractional exposure to the entire broad market.
And they get liquidity too, right?
Yes, open-ended mutual funds provide daily liquidity. You can redeem your units for cash at the net asset value at the end of any trading day.
It's a highly efficient system, but it is entirely rigid.
Very rigid.
You are essentially boarding a massive commercial airliner.
Yeah.
You get the safety and the efficiency of scale, but you have absolutely no say over the flight path, the altitude, or the timing.
None at all.
If you have a specific tax harvesting strategy you want to employ, the mutual fund manager does not care. They are managing the massive pool, not your specific reality.
Which is why, as an investor's wealth scales, they eventually graduate to the exact subject of this NISM workbook.
Portfolio Management Services, or
Yeah.
PMS. This is where we leave the commercial airliner and we charter the private jet.
Precisely. APMS is designed for high net worth individuals. The regulatory barrier to entry in India requires a minimum investment of 50 lakh rupees.
Okay, so a higher barrier to entry.
Yeah.
But mechanically, how is it different from a mutual fund?
It operates entirely differently. You are not buying units of a commingled pool.
So what do I own?
In a PMS, the investor retains direct, individual ownership of the underlying stocks and bonds within their own dedicated demat account.
Wait, really? I own the actual shares.
Yes.
What is the strategic advantage of holding the assets directly rather than in a giant pool?
Customization and tax efficiency.
Okay, unpack customization first.
Because you own the specific shares, the portfolio manager can execute hyper-personalized strategies. Let's say you are a tech executive and you have a massive concentrated position in your own company's stock from your compensation package.
Right, so my personal wealth is already massively exposed to the tech sector.
Exactly. The PMS manager can build a portfolio that intentionally shorts or completely avoids the tech sector to hedge your personal exposure. A mutual fund can't do that for you.
Oh, that makes sense. And the tax efficiency.
They can execute precise tax loss harvesting.
How does that work?
Let's say you sold a piece of real estate earlier in the year and generated a huge capital gain. You owe a lot of taxes.
Yeah.
The PMS manager can look at your personal account, find specific losing stock positions, sell them to intentionally realize the loss, and use that loss to offset your real estate gain, lowering your total tax bill.
The flight path is entirely bespoke.
Fully customized to your financial life.
And at the absolute apex of the managed hierarchy, we have alternative investment funds, or AIFs. This is the institutional realm.
The barrier to entry here is even higher. AIFs require a minimum commitment of 1 crore rupees.
So this is for ultra-high net worth families and institutional endowments.
Yes. AIFs are the vehicles used to access the illiquid, highly complex corners of the playground that mutual funds are legally barred from touching.
And SEBI categorizes them mechanically into 3 buckets. Let's break down the mechanics of these buckets. Okay. Category A, AIFs.
Category I focuses on the genesis of capital. These funds deploy capital into early-stage startups, venture capital networks, and SME infrastructure.
So this is the really risky stuff.
You are taking on massive business risk. Most of these startups will fail.
The payoff.
You accept that risk in exchange for the astronomical residual upside of finding the next generational tech monopoly before it goes public.
Okay. Category 2, AIF.
This involves private equity and private debt.
So buying established companies.
Yes, these funds buy established, cash-flowing companies that are simply not listed on the public stock exchange.
What's the strategy there?
They might buy a mid-sized manufacturing firm, use heavy financial leverage to optimize its balance sheet, completely replace the management team, and then sell the entire company 5 years later for a huge profit.
But I'm guessing I can't ask for my money back whenever I want.
No, it is highly illiquid, requiring capital lockups that can last a decade.
And finally, the most notorious. Category 3 AIFs. The hedge funds.
Yes. Category 3 is where the regulatory training wheels are completely removed.
Oh, so.
These funds are permitted to use massive leverage, complex derivatives, and aggressive short-selling strategies.
Explain the mechanics of how short selling fundamentally changes the portfolio's relationship to the broader market. Because people hear short selling and think it's just gambling.
It's actually a very specific structural tool. In a traditional mutual fund, you are entirely dependent on beta.
Beta being the general upward drift of the market.
Right. If the whole market crashes 20%, the mutual fund crashes 20%. You just ride the wave.
Oh, yeah, hedge fund.
A Category 3 hedge fund uses short selling to generate returns regardless of market direction.
How does that work mechanically?
They might identify a fundamentally flawed company. They borrow shares of that company from a broker, and they immediately sell those borrowed shares into the open market, betting that the price will collapse.
And if it does collapse?
They buy the shares back at the new, lower price, return the borrowed shares to the broker, and keep the difference as profit.
So if the market crashes?
Their long positions lose money, sure, but their short positions generate massive profits, which neutralizes the macroeconomic damage.
They're attempting to generate pure alpha.
Yes. Alpha is returns driven entirely by the manager's skill in identifying inefficiencies, completely divorced from the broader market's performance.
So the journey from mutual funds through PMS to AIFs It's really a systematic trade-off.
It's a ladder of complexity.
You are systematically surrendering the daily liquidity and the heavy regulatory protection of the retail market in exchange for the bespoke tax architecture, the complex leverage mechanics, and the entirely uncorrelated asset classes available in the institutional realm.
It is a complete evolution of access and mechanical complexity.
Wow, we have navigated an immense amount of financial architecture today.
We really have covered the entire waterfront.
We started by examining the inescapable biological reality of the human life cycle. The realization that we are all forced to shift capital across time just to survive the drawdown phase of retirement.
Right, the surplus to the deficit.
We defined the rigorous analytical process required to elevate our actions from mere speculation to true intrinsic value investing.
The presence of a framework.
Exactly. We mapped out how to mathematically calculate the exact required rate of return to overcome the silent dilution of inflation, the shrinking yardstick, and we explored the cascading interconnected dominoes of systemic risk.
The geopolitical supply shocks turning into liquidity crises.
Yep. And finally, we surveyed the vast mechanical ecosystem of the markets, from the residual liquidation claims of equity to the bespoke leverage architecture of alternative investment funds.
When you lay all the mechanics out on the table like this, you realize the global financial system isn't just a casino.
No, it's not.
It is a highly calibrated machine designed to price risk and allocate capital to its most efficient use.
And it is a machine you have to engage with. You can't just opt out. Which brings us to our final thought.
Yes.
We always like to leave you listening with a concept to mull over. Something that integrates everything we've discussed today into a totally new perspective.
And I think this is a crucial one. We have spent this entire session meticulously dissecting risk.
We really have. We calculated standard deviations. We looked at the terror of liquidity crunches.
The destruction of currency devaluations, the brutal reality of corporate defaults, the list of mechanisms designed to destroy your capital is, frankly, terrifying.
It makes you want to stuff it under a mattress.
It does, but I want you to trace it all back to the very first concept we discussed today.
The life cycle of savings.
Yes. The biological certainty that you will eventually reach a phase where your ability to produce capital drops to zero.
Retire.
While your requirement to consume capital continues until the day you die. Combine that certainty with the mathematical reality of inflation.
The central bank expanding the money supply and continuously shrinking the yardstick of your purchasing power.
Exactly. When you combine those two absolute certainties, aging and inflation, it leads to a really chilling conclusion.
What is it?
We spend our lives terrified of the volatility of the stock market. We are terrified of business risk and financial risk. But based on the mechanics of time and inflation, the single most catastrophic, mathematically guaranteed risk you will ever face is the risk of choosing not to invest at all.
Wow.
Holding static cash in a vault is not a defense against the world. It is a guaranteed surrender of your future purchasing power.
That is a profound paradigm shift. It completely flips the definition of safety.
Safety isn't standing still while the treadmill moves backwards.
No, it's not. Thank you for walking through this incredible architecture with me.
It was a pleasure.
I encourage you listening to look at your own capital tonight. Ask yourself, is your money just sitting in a holding pattern in the waiting room, slowly being diluted by the expanding money supply? Or have you built the architecture to deploy it into the supply chain of the global economy? We'll see you next time on The Deep Dive.